Hi there, I'm Daniel Lader, founder of Lader CPA and Associates, and welcome back to our new ongoing series, Tax Strategy, right here, right now, where we are talking about great ways to reduce your tax bill and skipping all the jargon. This week, our topic is on the QBI deduction, planning for it and using it. Now, if that sounds boring, good news. It's less boring than it sounds. So let's go ahead and jump right in. First off, the QBI deduction can save you real money, real tax dollars. But for many business owners, it's all about keeping your income in the right zone so you don't lose the deduction. So today's goal, by the end, I want you to know what the QBI deduction is, why your income level matters, and simple moves that help you to keep more of this deduction. So what is a QBI deduction? In simple terms, if you're a small business owner, like a sole proprietor, LLC, partnership, or an S corporation, you might get a tax deduction worth up to 20% of your business's net income. And that's pretty significant. And it's based on your business's net income, not on your paycheck that you might be paying yourself or take out of the business. Remember, it is based on your business's net income. After you might have already paid yourself if you're an S corporation owner, but not including any owner draws you might have taken. Now, it's not automatic for everyone. When you have a high income, this QBI deduction can be reduced or removed fully. So keep that in mind, and that's why we're talking about this. Now, the big question to ask when you're looking at the QBI deduction, are you an SSTB? Now, I'm throwing around a lot of acronyms. I apologize, but it's easier than saying the full term. An SSTB is a specified service, trade, or business. That's a fancy way of saying certain service-based jobs have special rules. Now, these are not better rules. They're actually usually less better, but they are special and treated differently. Now, health and mental health work is often treated as an SSTB type work. So if you are an SSTB and your income is too high, that QBI deduction can shrink and go away, potentially faster than if you were not an SSTB business. So there's one quick note to keep in mind. All of these things we're talking about, they depend on the facts. Many therapy and counseling practices will fall into this category of being an SSTB business. Now, for 2026, let's talk a little bit about the numbers. I know a lot of you are not interested in numbers, or numbers scare you, or it's hard to read numbers. I get it. But we do have to talk a little bit about numbers. So through the magic of editing, there is a table of numbers right here. These are going to be the lanes that we have to stay in to maximize the QBI deduction. As a married filing joint tax return, you will see that the beginning amount is $403,500 and the ending amount is $553,500. Keep that in mind. The numbers will float around somewhere, but stay here. Other returns, like a single return or head of household, the numbers change a little bit. We start at $201,750 and they end at $276,750. Now, for married filing separate tax returns, and these are weird, we just have to go with it. Their numbers start at $201,775 and end at $276,775. I don't know why they're different. That's weird, I admit. Now, what do these lanes and income ranges mean? When you're below that low number, your QBI is usually easier to qualify for, and you can usually take the full 20%. When you're between those two numbers, the rules start to change and your QBI deduction may shrink. When you are above the high number, if you're an SSTB, the QBI deduction will usually go away, be reduced to zero. And if you're not an SSTB, you might still get some QBI, but there's more limits that could apply to reduce it. So keep that in mind. This is an income-based or a taxable income-based deduction. Now, the good news is starting in 2026, that middle lane, that middle range is much wider. So some people can still get part of the QBI deduction even when their income starts to get higher. So that is a nice benefit for 2026. Now, what are some of the best ways to protect and preserve your QBI deduction? Well, the main move you can do is managing your taxable income. Keep that below that level where you can get the maximum QBI. Now, this matters the most for SSTB businesses. If you can lower your taxable income, you might stay in that QBI friendly lane. Now, there's some common tools we can talk about to keep your taxable income lower, especially at this point in the year. It's January, so if you're getting ready to prepare your 2025 or last year tax returns, these are some tips that can still apply, potentially. I'll tell you if they can't. First one, put money in retirement accounts. That is a great option. Most retirement accounts do allow you to put money into them after the end of the year that the contribution is applied to. So it's a great last minute control over your taxable income. Use an HSA account, health savings account, if you qualify. That's another one you can do after the end of the tax year you want it to apply to. You are able to give money to charity, and if that's an option for you, it's not something you can do after the end of the year, but it is something you can do during the year. It's a nice way to basically give money away to reduce your taxable income without having to search and look for a business deduction. Next, look for timing opportunities on your income and expenses near the year end. If you need to accelerate and have more expenses at the year end, keep that in mind. Or if you need to see if you can delay receiving some receipts, some income, see if that's an option for you. Timing. Last, buy any needed business equipment near the year end. But remember, only if it makes business sense. Don't buy yourself a Land Rover or a G-Wagon at year end just because it can get a tax deduction. If it doesn't make sense, it'll backfire and it will be a negative tax event for you. So keep that in mind. Now, a couple important ideas. The QBI is based on your business profit, but it's also tied to that total taxable income on your personal tax return. So planning is about the whole picture, not just one aspect of it. Now, if you are not an SSTB, specified service trade or business, and your income is high, the QBI deduction can depend more on things like your wages paid and business property, etc. That's where planning can get more detailed. We are not going to talk about that. That's way too detailed. Another update for 2026. This is a small minimum rule. After 2025, there's a rule that may give some people a minimum QBI deduction when they can qualify, if they have at least $1,000 of total QBI. For most growing businesses, the bigger savings will still come from the full 20% deduction. So keep that in mind. That's all we'll mention about that here. Now, some closing thoughts. QBI planning is not about tricks. It's about keeping your income in the best range so you don't lose a valuable deduction. 20%, that's a huge deduction. Keep that when you can. Now, if keeping the QBI could save you thousands, what's one move you can still make for the year? Is it retirement funding, expense timing, or income timing to stay in that best lane? So that's the conclusion of our topic. If you have more questions, reach out to your tax professional. Message me directly. I'm happy to answer questions about it. Next week, we're going to be talking about the home office deduction done correctly. So don't forget to like, follow, or subscribe so you are made aware of future events and see the tax advice and tax tips we're regularly putting up. Good tax advice, not the stuff that other people put up that's not correct. Visit our website, latercpa.com. Have a great weekend and keep helping others to help themselves. And let us help you to do just that. I'll see you next time. Bye.